How's it going, guys? My name is Franco. Today we're going to be going through one of my favorite plans for beginners, a simple trading plan that anyone can pretty well use. It doesn't take any time. So we're going to be going through the steps of how to make this plan, how we can implement it, if it's the right plan for you, sort of thing, and the importance really of creating a plan when you're going to be trading crypto or stocks or whatever you're going to be trading, because you don't want to be going in blind. That's when you're going to be making emotional trades, and it's important that we have a plan and we can stick to it. Alright, so let's get into creating a plan. So what I've got written here is when we are creating a plan, we need to assess what are our goals, e.g. making money in the short term, making passive income, etc. It could be a vast array of things of what you actually want to do. How much capital do we want to invest? So, this might be, I've got $1,000 and I want to invest that straight away, or it could be, I've got $100 extra cash every week after my paycheck, whatever it might be. We need to know how much capital we have so we can divvy it up, sort of thing, and figure out how we're going to best implement it. And then how much time do we want to spend each day, week, month on this plan? For example, if you just want a dollar cost average, that literally would take you 5 minutes a week pretty well. You just log into Coinspot or Swyftx or Binance or whatever you want to do and just buy Bitcoin, buy $100 a week. Or it could be a short-term trading plan where you want to invest a lot of time into it. So you're analyzing charts, you're trying to come up with patterns and trying to figure out where the price is going. That's obviously going to take a lot longer, and depending on you and how much time you have, you need to figure out what the best plan for you would be. Okay, so when we're creating a plan or to execute a plan, I've got written here, we need a buy trigger, a sell trigger, and an invalidation point pretty well. So we need a point where we're going to be obviously buying something so we can actually enter the market. We need a sell trigger, like where are we going to start taking profits? And then we need an invalidation point, so basically selling at a loss. So where does our plan, where does our theory break down and it doesn't look like whatever we thought was going to happen is going to happen? That's when we need to basically sell at a loss, or at least, throw that plan out the window at the minimum, sort of thing. Okay, so this is where we get onto my dollar cost averaging pyramid plan. So what is a pyramid DCA plan? So basically, it's a typical dollar cost averaging plan. So where you're kind of like buying every week or buying every month. However, the amount that is being purchased is determined by price. Lower price means more capital invested, and higher price means less capital invested. So pretty well, we'll have a quick look at the chart just to and clear things up a little bit. We want to be on this one. So you can see here that we've got our poorly drawn pyramid. You can don't worry about my artistic skills, but you can see here that basically we've got the higher the price, the less money we're investing. This isn't, I've just written random numbers, basically over random price points. But say the price is at above $4,000, you might be only investing $25 a week, or a month, or whatever it might be. But say the price is down, under $1,500, you're going to be investing $150. So depending on the price, we want to be investing more or less amount of money. And we'll have a look at this in action to show how the maths works out a bit better. So we go back to these questions we had at the top here. So like, what are our goals? Okay, so the goal is to make money over a longer period of time, months, years. So with pretty well any dollar cost averaging plan, you're probably not going to be expecting instant returns. It's not going to be, just looking at the 4-hour chart and making a quick buck day to day. It's going to be long term. You're going to be buying in towards lows and selling towards highs, and that, who knows how long that could take. I mean, if we just look at the Ethereum chart here, say you started buying, in June or May or June. You've been in this market now for a year, and you pretty well haven't seen any real returns yet. You're not selling. You've been dollar cost averaging for a year now. And there's probably still a lot longer to go before we see any real sort of money-making moves. So, it's going to take a long time if you're in a DCA plan, so you got to be prepared for that. Now, the capital invested, now this is obviously up to you, how much you're willing to risk, how much, basically extra cash you have that you don't need at the minute. And the time required is, I've got written here, very little. Now, because it's a dollar cost averaging plan, As I said before, it might only take 5 minutes every week. The only difference is that you just need to come up with some price points as to how much you're going to be buying at each separate level. So let's have a look at this plan in action now. Oh, hang on. Sorry, we've got one more bit here. So the buy trigger, so a DCA plan means we're buying consistently every week or month or day, however long you want to be, buying in. The sell trigger could be price based and time based, depending on. We'll go into this a little bit further, but depending on how you want to come up with your sell targets. And the invalidation point, I would say, would be the breakdown of lows. So if you're dollar cost averaging in this range, and say we break this low here down at 800 and what is it? Hang on, $880 or whatever it is. Say you break that, or we break down on that. That we could consider that an invalidation point, or maybe it would be this low here on this November candle. If that broke down, what is that? $1,071.50. So if that broke down, that could be our invalidation point. An invalidation point can really be up to you guys, what you think would invalidate your plan on dollar cost averaging. So let's have a look at this plan in action. So why would we implement a pyramid dollar cost averaging plan where, as before, depending on the price, it is determining how much we're going to invest every week or every month? Why implement this over just a simple, I'm going to invest $50 a week, I'm going to invest $100 a week, no matter what the price does. So by buying more at lower prices and less at higher prices, that should say, we create larger bases of capital at the bottom and make our average buy-in price lower. So you can see here, now the pyramid's a good metaphor here for the pyramid dollar cost averaging plan, because if price were to fall, say we implemented this, right here at the peak of the Ethereum, we said we're going to implement a dollar cost averaging plan each and every week, as the price falls, and we're buying in more and more and more towards the bottom, we're creating that larger base at the bottom, which you can see here. More capital is flowing in towards the bottom, $25 a week. We probably only invested, let's say we did $25 a month, just for the sake of, that's what the candles are on. We probably would have only invested, $50 down here. And then we might have invested $50 in this range. Here, though, we might have invested $75, 3 or 4 times. And then as we get towards the bottom, you can see here that with all these candles towards the bottom, we're creating a really strong base, and that's bringing down our average buy-in price pretty well compared to a normal dollar cost averaging plan where maybe we were investing $100, $100 every single week, and our price is basically, or our account, our wallet or whatever, is basically just bleeding money. If we invest only a little bit towards higher prices and a lot more towards lower prices, we're going to be turning out better results, that's for sure. So let's have a look at the maths of this. So a normal dollar cost averaging plan, say we invest $1,000 per month. I've just got simple numbers here just so my brain doesn't hurt. But say in month 1, Ethereum cost $1,000, or one Ethereum costs $1,000. So obviously we're going to be buying one Ethereum that month, $1,000. In month 1, and Ethereum costs $1,000. Of course, this doesn't have any trading fees or anything, but let's just say we get 1 ETH out of that. And then month 2, 1 Ethereum costs $500, so that time we get 2 ETH. So we obviously, 2 $500 ETHs is our $1,000 per month buy-in. Now that's just a normal dollar cost averaging plan, so we're just buying $1,000 a month. So we're going to end up with 3 Ethereum with $2,000 invested and an average buy-in price of $666.67. So you can see here that, because the price dropped down and we bought in at lower prices, that did bring our buy-in price down quite a bit, so that's nice. But if we were to be using a pyramid dollar cost averaging plan, say month 1, 1 Ethereum costs $1,000, and say we spent $750 of ETH, $750 towards the Ethereum that month. So we would end up with 0.75 Ethereum. So you can see here that because the price is higher, we're investing less. So we're only spending $750 instead of a default $1,000 every month. And then month 2, the price of Ethereum drops to 500, so the same, price of ETH as the previous example. But this time, because we're using a pyramid dollar cost averaging plan, we're going to invest $1,200 or $1,250. So, I can't even speak. $1,250. So, and that would equal out 2.5 Ethereum. So we end up with 3.25 Ethereum with $2,000 invested and an average buy-in price of $615.38. So you can see there that it's the exact same amount of money spent, $2,000, and the price of ETH was the exact same. Month 1 it was $1,000, month 2 it was $500. You can see here it's the exact same. The only difference was that when we implement a pyramid plan like this one, the first month, we bought in, don't worry about the prices on the side here, or that we're looking at a completely different chart, but pretty well. The first month when the price is high, we bought a little bit, and then when the price dropped down, we bought a lot more. And as we said, the metaphor, it creates a larger base towards the bottom, and that brings down our average buy-in price compared to just a normal dollar cost averaging plan where we're just investing $1,000 a month, no ifs or buts, and we end up with far less Ethereum with a far worse buy-in price, obviously. So that's the maths behind that, and you can see that a simple change in a dollar cost averaging plan could really save a lot of money and make a lot of money in the future, which is really, really important. So let's have a look at sell triggers. A sell trigger could be whatever you want, a particular price target to be hit, or a time-based sell trigger, such as following the Bitcoin 4-year cycle. So you could be saying, hang on, this is where I've actually got something hidden for you guys. So you can see here, it could be a price target. So you can see, I've got an inverse pyramid here. So say the price of Ethereum, it goes like this, and we hit these price targets. You could have a plan where it says, got to remove that because it's covering. Let's just do that just so you can see the triangle. As the price pumps up, you could be saying, I'm going to sell 25% of my portfolio. And then when the price targets gets higher, it hits this point, I'm going to sell 35% of my portfolio. And you can kind of see how this is like a inverse pyramid plan, because as at the lower prices, we're selling a little bit, and then as price gets higher and higher, we're really exiting the market. We're taking profits here for sure around these prices, but then as price goes up, we are exiting the market. We're trying to get out of the market, and it doesn't have to be like a portfolio. Hang on, I got to delete all these, but it doesn't have to be like percentage based. Like it doesn't have to be 25% of your portfolio. It could just be, as we hit these price targets, it might be $100 or $1,000, and then this price target might be 2,000, and then 5,000 and 10,000 as we come up through these prices. And we're basically, here we're taking a little bit of profit, and here, as price gets higher, we're exiting the market a lot quicker, because obviously the risk of dropping is a lot higher, and we're trying to take our profits a lot quicker. Now, I also said that you could use like a 4-year cycle or something like that. So your sell target doesn't have to even be, price based. It could be a time based sort of, plan, where basically you could be following a 4-year cycle. So you could, this could also be a way of starting your dollar cost averaging plan, where you wait for the bear market, and then once you hit an accumulation phase or something like this, that's when you can go, okay, I'm implementing my pyramid DCA plan, and I'm basically just going to be, so if we have a look at the Ethereum chart, you could, what am I drawing? Sorry. You could implement your dollar cost averaging plan like, a year down. So you could say, date range, I'm going to wait for price to fall for a year, and then just here, oh, that didn't stay on there for some reason. That's always fun. So we're going to wait for a year down. Oh, because I've got to press it again. There we go. So we're going to wait for a year down, and then this is where we're going to actually implement our pyramid DCA plan. And you can see that buying in heaps at the bottom here, buying in a little bit less towards the top, all those sort of things basically. So So it could be like, implementing, buying in, using your DCA plan here, and then basically, towards this accumulation phase, and then waiting for the expansion and bull market, and then you're basically just selling based off time. So you could have said, back in the last bull market, I'm buying in around this time, and I'm going to be selling, you just have to look a year or so out from the halving. I'm going to be selling in May 2020. I'm going to be selling in May 2021, and you would have basically sold the top of the market. It could just be that simple, or maybe you just want to, DCA it out sort of thing, where you're kind of like what we were doing before, where you sell a little bit, and then as time goes on, you can sell more and more until you're basically all out of the market, which could be a really good plan. Now, can we expand upon this plan? So introduce other factors to determine when we are DCAing, as such as a 4-year cycle. That's just what we were talking about. Or you could be looking at Wyckoff accumulation and distribution patterns or something like that if you're more into those sort of things. But basically that's what we were just saying, where you might be wanting to use the 4-year cycle to trigger the introduction of your pyramid DCA plan sort of thing. So we're in the accumulation phase now. I want to start DCAing, and my sell target is going to be 1 year after the halving or something, basically. Or you could go the other way. If we look at a simple, it's not going to be on here now, is it? But if we look at like a Bitcoin chart sort of thing, and we're just looking at like this range in here from here through to here. A lot of people have recognized this is kind of like a Wyckoff distribution phase, where you've got like your selling climax, your automatic reaction, all that sort of thing, and all your phases. So like phase A, phase B, phase C, and then you got phase D here. You could be looking at it like that. If you're a bit more into technical analysis, of course, that's going to take a little bit more time. You can see here how this sort of pattern looks kind of similar to the Bitcoin pattern we've got here. It's pretty similar in a sense that you got like the down, a quick automatic rally, and we go down, and then we kind of churn, and then we get our breakout, which is basically what we've seen here. Down, like a automatic rally, and then we go down a bit and we churn, and then eventually we get the breakout. That could be, if you're more into technical analysis, that could be your kind of buy triggers when you see this sort of these sort of patterns play out, and then you could introduce your dollar cost averaging plan here. Or you could do it time based. There's heaps of different ways you can do it. I'm not going to stand here and tell you how to do it, because that would be irresponsible. I'm not a financial advisor, of course. But so that's pretty well a simple DCA plan, and it's a lot better than just a normal dollar cost averaging plan. You can see how just a little bit of effort, introducing a little bit of maths to our investing can save us a lot of money. It can make us a lot of money in the future, because if ETH hits, $10,000, we've made an extra $250 or something like that, just by using this plan with these couple of buy-ins. But you can see how a little bit of maths can make a lot of money in the long run. And, it's always important to try and be updating your plans and make sure they're, as good as possible, and, figuring out how can we get the best out of our money. And this is just a very simple way, I think, for beginners. If you're, if you've just been dollar cost averaging, like I used to be for the longest time, something like this can really save a lot of money, a lot of time, a lot of effort. And it's a simple plan to introduce. It's literally just, if we go back to our ETH chart, it's literally just drawing a couple of, drawing a couple of lines on a chart, just extend these out, bada bing, bada boop, and we're in our, $125 range at the moment. So if you're buying in every week or every month, based off these prices, they could be anything. It could be $200, could be $1,000, I don't know. It could be $10, it doesn't matter. That's how much you're going to be buying in every week. And if price goes up, you're buying in less and less up here and less up here, and eventually to where you're basically buying bugger all towards the top, and then you're looking at selling. But that's basically it for this video, guys. A simple dollar cost averaging plan with a little bit of a spin, the pyramid plan. It's going to save you guys probably a lot of money if you implement it well. Of course, you have to be responsible with these sort of things, where, only invest what you're willing to lose. And of course, the tough part's going to be kind of figuring out those what prices you want to go where, sort of thing. Like, how much are you going to invest at each level? That's going to be up to you guys to figure out. But, play around with it. Think about it for a little bit. It could be a great plan for you guys to implement. If you did enjoy watching, I've got to stop playing around with this chart. If you did enjoy watching, though, of course, feel free to like and subscribe. I've got some referral codes down below for Coinspot and Swyftx, a couple of Australian exchanges for you guys. So feel free to use those. You'll get $10 worth of free Bitcoin. Anyways, that's going to be it for today, guys. I'll catch you later. Bye.